All right, before we head in this week, for those subscribers to the Applied Series, Portfolio Management Part 3 Rolling Options, plus Risk Management with Short Options will be up Monday. And in the Market Outlook Extras, I'm looking at CL, which is West Texas Intermediate, and RBOB, which is gasoline. And I'm looking at the difference in inventories and the difference in the futures term structure. I'll show you how to look at that. And from that, we can come up with a pairs trade, long one, short another, depending on what your belief is based on what the term structure looks like. Well, the fixed income market had a wild ride last week with a crazy Friday. And the turnaround came with some Fed speak. So we'll go through the Fed speakers for the week and some really interesting stuff to look at there. But let's look at what happened to our rates. We have new high rates last week at the, let's see, the 1 month, the 3 month, the 6 month. It seems to be skipping tenors here. The 2 year and going from the 3 year onwards, still the October highs on yields are still in place, but could be threatened. Where's the interesting story here? The 10-year, 3.97. It got to as high as 4.04, 4.05 intraday, and then pulled back to 3.97. We can see that rates have now risen all the way to the 10-year since the beginning of the year. The 20-year and the 30-year almost flat for the year. FOMC meeting on March 22nd is 17 days away. Not only are we going to get a rate announcement, we're going to get a new summary of economic projections. And I'm absolutely certain that terminal rates are going to be higher in this SEP than they were in December. It'll be interesting to see what their forecast of growth is going to be. If they're going to forecast the same growth but a higher terminal rate, you sort of have to put a big question mark around that and say, really? You think you can take it higher and not have any effect on growth? So we'll see how consistent the SEP is going to be. Jobs, March the 10th, that's in 5 days. Was the anomaly, I'll put it in air quotes, the suspected anomaly we saw in the January number real? Or was it just because of seasonality? And one of the Fed speeches, that question is asked as well, whether or not it was just seasonality. But we'll see in 5 days. CPI, March 14th, that's in 9 days. And to add more volatility to the week, Powell, Tuesday and Wednesday, starting at 10 a.m. It's the Humphrey Hawkins hearing. He gives testimony for 2 days. Fed officials do that every year for 2 days. So we'll see if he, with his prepared remarks, is a little bit more on message. But then it's a whole bunch of questions and answers, and we know he just doesn't do well with those because I think he doesn't stay on message. I think he just speaks his mind, and sometimes, dude, you gotta keep that to yourself for a while. Our slopes. Somebody asked if I could just put the dates typed in. So yeah, I just stuck it in there. Maybe it's easier that way. The 2 to the 10, 242 days now. It seems stuck right around the 80 to 90 basis point levels, been there for quite some time. The 3 month to the 10-year was uninverting. It has inverted a little bit more, 3 basis points here. We're 130 days on that one now. Other curve inversions in the money market rate. The 3 month rate 18 months from now minus the current 3 month rate is negative 74. Last week it was negative 75, so it's not uninverting any further there. I'm using 3 months SOFR to get that done. The effective federal funds rate sitting at 4.57. It's either 4.57, 4.58. It barely moves. The reverse repo up another 44 billion for the week at 4.55%, and that is at 1 day SOFR rate. Fed balance sheet still continuing its runoff, down another 38.1 billion. So we're at 7.848 trillion. Treasuries dropped by 30 billion. Tips increased by 2 billion. And I don't think that's because they bought any tips. I think that's simply just the principal adjustment. All the principal increased by 2 billion. And MBS decreased by 10.2 billion. In Mary Daly, in her Q&A on Saturday, she was at a Princeton symposium on policy. In her Q&A, she was talking about the effect of the balance sheet. I think it was her, or maybe it was another Fed official, talking about the effect of the balance sheet runoff and what the a proxy rate would be because of it. And it's something in the around 6% instead of the 4.5 that you see. That it is, had they not run anything off, it would be the equivalent of having raised the rate to 6%. I don't quite know how they measure that, but I'll throw that number out for you. The probability for 25 basis points decreased just slightly, sitting at 71.6. For 50 basis points, 28.4. This should be a 2 over here. I don't know why I wrote 18. That should be a 2. 28.4%. I just don't see how, maintaining their credibility, they would shift back up to 50 after telegraphing the rate decrease to 25 over the past couple of months. That I think that they'll probably be more likely to stick with the 25, to stick with that at this point, but just signal that, you know, it's not 2 or 3 more, but it could be 4 or 5 more 25s. It's that stress the cumulative amount that they've done so far and how much more work they have to do. So I don't know that they're going to, I don't know that they'll shift back up to 50. I think they'll just keep adding one more meeting to the end of the line. If inflation is not behaving. So I'm sort of thinking that there is only one option for them at this point because of the way that they've guided forward on this, that I think they're kind of locked into the 25. For June 14th, the 6% getting a little bit more weight, 2.1% from 0.9, but it's there, right? 5.5, 56.8 to 56.5, kind of the same, but 5.25 has dropped 5% and the 5.75 has increased. So you can kind of say that 5% has found its way, 5% of the probabilities found its way higher, but 5.5 seems to be the number now to look at, which is, that's the upper. When I write this down, that's the upper end of the range. The upper end of the range now is 4.75. So that's three more hikes. 5.75 is 4, and 6 is 5 more rate hikes. So the market seems to be fairly centered or anchored a lot on 3 at this point. The predominance of the probability being there, 56.5. Real yields have all dropped week over week. And if we look at the nominal rates, the only rate that dropped was the 30-year week over week, 3.93 down to 3.9. The 20-year basically flat, up 1 basis point. The 10-year up 2. But real yields have really dropped, and this is really the driver of valuations. Are changes in real yields. As real yields start dropping, valuations start increasing. Because that real is the true real discount rate. You have an inversion here still of a negative 10 basis points. If on a day-to-day basis, if you just gave me this row over here, just the change in real yields, I can tell you what the change in the IYR is, which is the real estate REIT, because it responds really tightly to changes in real yields. And this change in the real yields really came on Friday. A lot of this came on Friday, and of course IYR and the markets were up on Friday. It's got a very high correlation with valuation. Break-even rates. This is, we can't look at them and say, well, there's not a lot of movement here, we can't read anything into it. There is a lot. 24 basis points on the 5-year, even going out to the 10, you have 14. When we look at what the nominal yield did, it added 7 basis points over the week, and the break-even rate added 24. So for the nominal yield on the 5-year to add 7, that means there was some selling on the 5-year. The price has to be lower for the yield to be higher. But if you look at the 5-year real yield, it dropped from 172 to 155. So more money was going into tips than treasuries at the 5-year. Money was coming out of the 5-year because, of course, the price is lower, whereas the price is higher on the 5-year, pushing that inflation expectation up. This could be an early warning sign, and I don't think this is a move that anybody on the FOMC really wants to see continue. Fed funds futures continuing to get the message. Last week we had August, September, October, the index bottoming out at 94,605, implying a rate of 5.395, put you firmly in the target range of 5.25 to 5.5. Now at 94.55, same August, September, October, but now 94.55, which is a rate of 5.45. Still in the range of 5.25 to 5.5. You can even argue that, well, you can extend that range to 5.75 because it's sitting kind of in the middle. If it were 5.25 to 5.5, you'd expect the middle of the range 5.375. Yeah, that's kind of sitting nicely in the middle of that range, but this is pushing up to 9.5, suggesting there's some weight at the 5.75 pulling it up. Going out to December, 94.695 is now 94.65. So the year-end rate at 5.305, that's not a 4, that's a 5, is now 5.35, a drop of 10 basis points. And February, 94.8, which suggests a rate of 5.2. If we look at the 1 year forward minus the current 1 year, negative 51 basis points versus negative 54 basis points. And what's going on in 2024? The terminal rate this is using 1 month SOFR, which should follow the Fed funds rate fairly closely. December 23rd, 5.31, December 23rd, December 2023, December 2024, 399, 134 basis points down. Last week it was 138. So slowly the expectation is coming out of 2024 for rate cuts. TLT, what a wild ride throughout the week. Up 1% on the week. The SPY was up 2.13%. And I use a Friday closing price on these at 4 o'clock. I just look at whatever the Friday closing price was at 4 p.m. And then use that for the opening price based on what closing price it had Friday at 4 p.m. as well. Look at implied volatility here, 13-week up to 37% from 30. So it is increasing. I took Friday as an opportunity to roll my puts. Remember, I had 104 puts, so I rolled my puts. If you have the applied series, Monday, part 3 of the portfolio management series will be up, as I said at the very beginning of the video, and in there I will show you how I rolled my puts, not only for a gain in my premium, but also a pickup in the strike price. I rolled down to 103 and added to my total premium as well, which really lowered my break even. This, if you're a technical trader, that is troubling, right? That gap. All downside gaps eventually, or all gaps eventually get filled, so we might expect a retracement to fill the gap if we still expect it to move up, but that gap is troubling. It would be a nicer chart if it didn't have the gap, from a technical perspective, if you're into that sort of thing. Looking at the spreads, OAS, absolutely no concern at all. All of them week over week have tightened. This is really impressive that Triple C is just saying, wake me up when something happens, right? 6-month U.S. Treasury sitting at 5.18. The 1 year is at 5.03, and the 1 to 3 year investment grade is 5.64. Not a lot of spread between what you can get for a 6-month and a 1 to 3 year. And if we believe the Fed, no rate cuts this year. In fact, we're going 75 basis points higher. I don't think that 1 to 3 year IG is where you want to sit. You want to sit in the 6-month right now, and then in 6 months, you see where the Fed is and what's going on. Then you may want to roll over into something else. Unless, of course, you expect a recession and rates to be cut, then you don't want to be anywhere near corporate bonds, or you don't want to have any exposure to the spread, because spreads would widen, especially on high yield. That's why I think you're sitting in high yield right now. You're, sort of sitting in front of a potential recession, sort of snubbing your nose at it, saying, yeah, let's see what you got. Show me your best, because that is what that is saying right now, is that we don't care. We don't think you're going to happen. We dare you to try. High yield at 418. The high yield 8.62. That is that's not the expected yield. That is just the spread, the current spread plus the Treasury. If you want to know the expected return on something like this, you do have to take out any defaults, the potential for defaults, and defaults in high yield do happen, so you have to adjust that yield for default. So you're probably not getting 8.62, and you're probably not getting 418 basis points. Mortgage market 6.65 for a 30-year fixed rate, up 15 points. This is according to Freddie. If we look at the Mortgage Bankers Association, 6.71 as of March 1st. Mortgage News Daily on March 2nd had it at 7.1. March 3rd, 6.97. And we saw the home builders pull back all week long as mortgage rates increased. We had a rally on Friday as mortgage rates started to give back. 10-year Treasury week over week, this is Thursday over Thursday because this ends Thursday, was up 20 basis points. Fixed rate mortgage was up 15, so the spread has decreased by 5 between this. There is some support for mortgage REITs. Mortgage applications, well, is that a surprise? Negative 5.7, refis down 5.5, purchase index down 5.64, February 24th. That's not a surprise. This is probably the most interest rate sensitive sector of the economy. And if we're asking if interest rate hikes have done its job in housing, yeah, in housing, sure. You typically would see it in the auto sector as well, but we're not seeing it there. And I don't think we will, because of the way that the car companies are now behaving. And I will expand on that in a little bit. Pending home sales for January, month over month, up 8.1%. Year over year, still down, negative 24.1%. Case-Shiller Home Price Index, month over month, has pulled back, negative 0.9. It's not a big move, but still. Year over year, now up only 4.6%. We're done with those double-digit numbers. You'll recall that it was for a long time up 18%, up 16%, 14%. It was double-digit for quite some time, 4.6. Still year over year, up 4.6. So if we went back to this time last year and I said mortgage rates are going to push well above 6, maybe even push to 7, Fed's going to raise rates above 450 basis points over the year. In a year, where do you expect house prices to be? You probably would have said down 10, 15%. You wouldn't have said, oh, I think they'll be up another 4.6%. But there it is, up 4.6%. So, all it did was it took the frothiness out, but it has not really affected the upward trajectory of housing prices. Home builders, what am I doing here? Being that we are higher for longer, and I think mortgage rates are going to stay probably 6% plus for some time. They looked like they were going to threaten to print a 5 handle in January with all the exuberance going on. And you'll recall back in January when we were looking at capital market rates, while the Fed was talking about more rate increases, the market had gone ahead and cut rates on the 10-year by 40, 50 basis points since January 1st. Mortgage rates were under 6.1, heading to print a 5%. Remember the numbers we saw for mortgage applications, up 17%. I think there was one that was up 2-3 weeks in a row, up 9%, up 17%, up 12%. So it looked like, the market had decided that the Fed was done at that point, and home builders did well in January. I was selling calls on them because I just can't see them breaking out to new all-time highs, and they were all like not all, but Lennar and D.H. Horton were somewhere around 6-7% from printing all-time highs. It just didn't make any sense. Well, now that this seems to be probably going to be for the year, that the fix is in for the year on the mortgage rate being 6% plus. For the next 3 to 6 months for the home builders, I'm going to sell calls on any rallies on the shares that I have, because I just don't, not that I'm bearish, I just don't see the upside, so I'm willing to sell that part of the distribution to somebody else. I'll continue to own them for their dividend and sell that upside distribution to increase the income that I have on them. And on sell-offs, if they're another week like we had where all the bond market's clutching its pearls and running for the exits, I will sell puts on them to increase my position, 30 delta puts. In the long term, I'm going to be making home builders about 7 to 10% of my equity allocation. So whatever equity allocation I have in my portfolio, home builders itself, the category, is going to represent somewhere around 7 to 10%, which is a fairly large weighting in the sector, but 7 to 10%. And miners, I think, are going to be the equivalent for that as well, 7 to 10% on a going forward basis, long term. Now, I could just add them now and say, well, look, I believe in the long term, so who cares what happens this year? But if you're going to be tactical, you can generate a higher return by using those options, right? Selling the calls on rallies. And if it does get called away from me, the price is probably too high to begin with, given where we are. Unless I see mortgage rates clearly on its trajectory down below 5, and the ability to enter into the 5 handle and stay there, I just can't see how we can go, how home builders can get much higher. All right, some headlines for the week from February 25th. Subprime auto lender American Car Center closes for business. And this is one day after pulling a $222 million bond sale. They're owned by York Capital. 288 employees will be released back into the ecosystem. This is not surprising. It's subprime. These are people with questionable credit to begin with. And you raise rates considerably, well, this is not surprising. This is why the market's really not looking at this going, oh my God, look what's happening here. You would expect things to break. As interest rates go up, things will break. This is an expected thing to break. Another default on commercial real estate, Blackstone defaults on 297 million euro securitized Finnish office loan. It was higher than that, but they had paid it down to 297. I think it was over 500. This just was the remaining balance. Blackstone's, this is plus this happened plus this Blackstone $71 billion unlisted real estate income trust, BREIT, has also been in hot water on Wednesday. This is March 1st. The BREIT said it was forced to limit withdrawals for the 4th straight month. So commercial real estate is having trouble. While commercial real estate typically is financed with floating rate debt, and you have interest rates that are going up, and this is office REITs. The back to work just hasn't really taken up where it needs to be. The amount of people heading back to the office is still below pre-pandemic levels, but it is increasing. So it's no wonder that office REITs are in trouble. I have gone through all my REITs, and anything that had office exposure more than 20%, I've gotten rid of. Or I am in the process of getting rid of, because some don't trade that much per day, so you can only release a certain amount per day without pushing the price down. but the prices have been going down on the office REITs. So I'm getting far away from that sector as I possibly can. Silvergate suspends crypto payments network. More trouble in the crypto market. The most solid thing in the world is having trouble. This just seems rather surprising. You wouldn't expect to see it in crypto, but there it is. So during the week in my news feed, I saw a title go by along this lines, earnings quality worse than 3 decades. So I had to click on it, and it was a story from BNN Bloomberg. Something like that. You see a title go by like that, and in the news feed, if you follow IBKR, everything is the same as it flows by. Like there's nothing that highlights one news item from another. So it's not as if they're coded in different colors where you can see something about them. It's the same as everything else. And I mean, if you're going to fly something like this through my news feed, you got to bold that stuff. You can't just let it go with the same font size as everything else. Anyways, it's a news story, and to make it a little bit more manageable, I copied it into Word because I wanted to highlight certain things. So I'm not plagiarizing here. I told you where it was. It's just I wanted to highlight, and you can't highlight a news story, so I thought I'd put it in Word and highlight here. Let's see, potentially ominous development. You can take out the author's exciting words here. We're just looking for the facts. Earnings across U.S. industries have started to expand noticeably faster than cash is coming in the door. Income at S&P 500 companies adjusted for amortization and depreciation. Okay, what does that mean, adjusted for depreciation? If you take a net income and you look at cash flow from operations, you should expect to see cash flow from operations to be higher than net income by the amount of depreciation and amortization because it's non-cash. And in that cash flow section, if you have no accruals and you have clean accounting, your cash flow from operations should be higher than your net income by the amount of depreciation and amortization. So what you do is you take your net income and you add back depreciation and amortization to compare it with cash flow. So adjusted for amortization, depreciation, top cash flow from operations by 14% in the year through September. So that means what companies were reporting was roughly, adjusted for the depreciation and amortization, that was roughly 14% higher than the cash that actually showed up. In other words, for every dollar of profits, only 88 cents was matched by cash inflows, the largest discrepancy since at least 1990. And the story then goes on to say that, it happened, there were 2 particular times where this happened, and it tells you what 2 times, and they're not good times. The widening gap likely highlights a harsh business environment, raising questions over the reliability of the corporate resilience stock bulls like to highlight. While financial results largely came in better than expected last quarter, the number of loss-making firms is hovering near a record high. And that's what this chart is. This is the number of unprofitable firms in the Russell 3000. I think it's the Russell 3000, and it's just going straight up. This is 1980 to 84, 2015 to 19, and here you are way up here. Managers are under so much pressure to deliver earnings that they're using a lot more accounting than they have in the past to make their earnings look good. And whenever there's a quote, I always like, well, who said this? Sanjeev, alumni professor in asset management at Cornell. Measured against assets, the median company in the S&P 500 saw this type of cashless earnings, items that in accounting parlance fall into a category known as accruals, where a dash of management judgment is part of the calculus. Let's see, type of cashless earnings rise to the highest on record last year, according to data compiled by UBS. At the center of the worsening situation is a surge in inventory. And we saw that in Q4 GDP, where the inventory build was significant. As a way of illustration, consider Deere & Company, just to reiterate, to remind you what we saw in Q4 under the I sector. The 2 things we don't want to see is a drop in fixed investment and an increase in inventories. That's exactly what we had, a significant drop in fixed investments and a significant rise in inventories. Deere For the year through January, the company reported net income of $8.2 billion. Isn't that incredible? $8.2 billion, compared with $6 billion in operating cash flows. Contributing to the gap was an increase in accounts receivable of $3.4 billion. Pulte, it booked $2.6 billion in profits last year on the back of almost $670 million of cash flows. Hindering cash generation was a $2.3 billion buildup in inventory. Worsening earnings quality is prompting concern, especially since corporate earnings were often cited as one big driver behind the latest rally that lifted the index as much as 17% from its October low. If the trend in accruals is any guide, all the positive surprises in profits perhaps weren't as much to cheer about. Keith Parker, head of U.S. equity strategy at UBS, views the expansion in accruals as a sign that the cycle of earnings downgrades is far from over, and the new year equity rally will likely fizzle out. This is a powerful paragraph right here. It's just another marker that points to earnings power being less than what we're seeing on the headline level. When you do the math on what's the difference between earnings and operating cash flow, that wedge points to considerable risk to earnings if they were to catch down to cash flow, something on the order of 15% downside. Well, we're sitting at 219 now in 2023 forecasted earnings. 15% of that's $33 down. You're heading down into the 185 to 190 range. Even if you get really aggressive and put a 20 multiple on that, you're some 8 or 9% below, almost 10% below where the market is now, assuming that. Accruals anomaly, documented in 1996 by Richard Sloan, a professor of accounting and finance now at the University of Southern California, refers to a pattern that firms with high accruals tend to perform worse than those with low accruals. If you're a CFA candidate, we looked at earnings quality in level 2 FRA, the last reading in level 2, or the second last reading, I think, really looked at earnings quality. And this is what it's questioning right now, is the quality of earnings. Here, on to another point. As of the 12 months through January, roughly 32% of the firms in the Russell 3000 index were losing money, according to data compiled by Kailash Concepts Research and Bloomberg. Before the pandemic, only twice since '78 has profitless firms been so widespread: in the dot-com era during the early 2000s and the aftermath of the 2008 global financial crisis. Yeah, it's earlier I said the accruals lowest since 1990. I said there are two other times. It was actually the profitless firms that had two other times. That was the end of that. But there is the increase in profitless firms going on. You can see the spike here in 1999, and then how the number of profitless firms dropped. And then you can see the spike again here, and then this little spike here was sort of just above it at 40%. It is coming down though. All right, let's look at some of the Fed speakers for the past week. We'll look at three: Barkin, Bostic, and Daly. And for Barkin, we'll actually read the text of his speech because it is super interesting. Lots of good information in there. So let's start with some of the highlights from Barkin. Once the 2% PCE target is met, they can revisit the target, but not now. There's a lot of discussion of why not make it 3%. And the FOMC is rather firm on this, saying, nope, we have to run to the other side of the field and at least touch 2% before we can even talk about it. And it makes sense. What if they raise it to 3% now? Well, then the market will just believe that in time they'll raise it to 4%. Or they'll raise it to 5%, so that inflation expectations will become unanchored at that point, because, well, what would it matter? They'll just change the target. They gotta stick with the 2%. Saying there'll be no pause, just smaller ongoing rate increases, and returning to 2% a lot more time and effort. Effort meaning how many more raises there are. No rate cuts this year. For Bostic, the Atlanta Fed raise rates to 5.25 and leave it there well into 2024. And this is what caused the market to sort of turn around and begin to rally. And you saw it midday. There was a big jump midday in the S&P, and then it continued on from there. It was thought that, okay, well, he's saying 5.25, let's focus on that. And this is a clip from what he said. Here's what I will need to see to consider revising the course of monetary policy and narrowing of the gap between labor supply and demand, and said that demand exceeds supply by about 4 million workers. 4 million workers. So I did a little bit of arithmetic on this. That's 2.4% of the current labor force. To make up that 4 million, the participation rate based on where population is, so you take the labor force and you divide it by population. Well, add 4 million to labor force divided by population, you'd have to get the participation rate to 63.85. Right now it is at 62.4, and that may not seem like a lot to do. So I gave you a graph at the bottom here of the labor force participation rate from Fred, and I drew a line at 63.8. Here is where we are right now. And when was the last time it was at 63.8? January of 2012. So this was going on long before the pandemic happened. And if we have a shortage of 4 million workers and you need to get the participation rate back to 63.85, what you're saying is what we would like to do is reverse the last decade of decreasing participation rates and get back to where we were in January of 2012. Do you see that happening? I don't. So this is what he wants to see to consider reversing the course of monetary policy. You can sort of take that off, saying that's a big ask. Higher interest rates more decisively affecting aggregate demand. And Daly has something to say about this a little bit later on. But as I mentioned in previous updates, there's about 70%, a little over 70% of income earners that spend every penny they make. And when I say they spend every penny they make, that doesn't mean they don't have savings. Off of your paycheck, you have forced savings. For example, everyone in Canada contributes to the Canada Pension Plan. Now, they get that back when they retire, but that is a forced savings. They have no choice but to contribute, and then the employer matches it. I think it's 1.4 times. So for every dollar we take off an employee, we have to throw in $1.40 of our own. So those are forced savings. So it's not as if they don't have savings. They do have those forced savings, but if they walk home with $1,000 paycheck, they spend $1,000 and then pull out the credit card to hit Tim Hortons on the way home. You give people money, they will spend it. It doesn't matter what the interest rate is, they will still just spend. They'll buy whatever they can. And he also went on to say that he is only seeing the effect right now in housing and commercial real estate. Well, we see it in housing, and for commercial real estate, it's mostly in office buildings that we're seeing it now. Higher interest rates more decisively affecting aggregate demand, and as long as you have labor hoarding and a tight labor force and increasing wages, you're going to have increased spending, because that 70%, you can always count on them to spend everything they make. Ongoing recovery in aggregate supply. Well, the biggest aggregate supply is labor, right? Reduction in the breadth of inflation and stable inflation expectations. Well, 25 basis point increase on the 5-year break-even rate does not look like there's stability there. And we'll look at the text of Barkin's speech, and he says that he is troubled by what he sees in there. So we'll have a look at that. He points out a really interesting thing. He's saying you can't just look at the inflation expectation, you have to look at the range of inflation expectations. All we get when we see the number is the number. If we look at the Michigan survey, is you get, well, inflation expectations are this, but he points out that the range of answers is super wide, and whenever they are super wide, they usually are followed by higher inflation expectations. So he's concerned about what he sees under the surface. He's not just looking at the surface. And this 25 basis points that we saw in the 5-year inflation expectation, the increase, That's not just small pricing during the course of the day that if the market were open 5 more minutes, it would have changed. This is not a basketball game. This is a football game. Okay, let's look at Daly's comments from March 4th. This was the Princeton Symposium on Economic Policy, or Princeton Symposium on Policy. You can type that in on YouTube along with the name Daly, and you'll get that video. 4 concerns regarding inflation. First one, decline in global price competition. The move for reshoring, at least to the extent that it raises costs. Globalization was a large force in the last 20 plus years of disinflation, and if that's going to reverse, you can't expect that disinflationary process to continue. So at worst, it would end the disinflationary process, or sorry, at best it would end the disinflationary process. At worst, it would begin to reverse it and keep prices elevated. Domestic labor shortage, stating it will probably persist. The participation rate may continue to decline. So going back to Bostic's comment about 4 million labor shortage, 4 million person shortage, that the participation rate mathematically would have to get to 63 point, almost 63.9 to cover that 4 million from 62.4. Never mind it going up to 63.9. Daly says it may continue to actually decline. The green transition, new investment costs are going to be passed on. We're seeing this in the EV space. Try to find an affordable EV. That is the goal right now, is to try to produce an affordable EV. But with battery material pricing where it is and expected to go higher, if everybody rushes into the space that has announced that they're rushing into the space, there is not enough battery material that could be mined right now to satisfy all of those players. So there's going to be upward pressure on that pricing, and the possibility inflation expectations could change. And the blue writing underneath are my thoughts, and it came from 2 sources. I thought about the term inflation expectation, and I thought, well, for some people it's not just an expectation but a desire. Inflationary expectations turn to inflationary desires, and if it's not an outright desire, there is at least an anti-disinflationary mindset in some producers. So you could get anti-disinflationary practices. So let's take GM in Indiana. They shut down the truck plant there for, I think it was 3 weeks. And they cited supply chain issues. And not what you think. It wasn't because they had difficulty in their supply chain. It's because they had no difficulty in their supply chain. So suddenly production started to tick up. Oh, well, that should be a good thing, right? No, shut it down. We don't have the demand for those extra vehicles. We don't want to oversupply the market. We don't want to have to create the demand. We have a lineup. People are showing up on their own. We don't have to offer discounts. Do not overproduce. Only produce to the demand that we have. So they shut it down. Well, if you have more vehicles, you would then begin to offer incentives to move those vehicles. Well, they don't want to go back to that. They have had a couple of years of being able to sell everything they make, of increasing earnings, increasing cash flows, and they do not want to go back to the days where every September you're offering employee discount pricing, $5,000 in rebates, $10,000 in discount. They don't want to go back to that. So that's one example that I picked out. How many other companies out there are sort of thinking the same thing, being OPEC-like in their production? So OPEC meets every now and then and says, well, we expect demand to be this, so let's adjust production so that we don't oversupply this market. Well, is that tacitly going on in boardrooms across the U.S. right now, where they're saying, hey, listen, it's been pretty good. We've had a taste of these margins for a while now. Don't really want to give them up. So why don't we start thinking about producing to demand? Why don't we start managing our production a little bit more carefully to always keep the market in sort of a slight, imbalance or slight deficit, because that's what's going on here. As far as inflationary desires go, this comes from listening to somebody talking about their wage, and they were talking about their expectation that they're going to get a 10% raise. They got 10% last year, they're going to get 10% this year. And it occurred to me that, it's not an expectation now, it's a desire to get that 10%. Even if the market is not going to support it, how do you get employees who have gotten, outsized wage increases for the last 2 years to say, okay, all of that's over now, and we're going to go back to something a little bit more normal? And we say that wages are sticky, and they are, but the annual increase that you get, and everybody expects some increase in wages every year. Every year you expect some raise for being a year more knowledgeable, having a year more experience. You do expect that becomes sticky as well. If you were getting 3% a year for the last 5 years, you expect that you'll get 3%. But if suddenly you got 10% and 10% to go back to 3%, that's going to be a little bit difficult. So I don't know that I would call that an expectation so much as a desire. So you do have, I think, some firms and some individuals that have inflationary desires. And you have some firms, I think, that will follow some anti-disinflationary practices like GM. And I don't think they're going to be unique. All right, she had 4 good questions. I took the 2 best ones. The first one was really good. The person asking the question cited the term long and variable lags and said, yes, they are variable, but they're not long. A lot of research has shown that they are 2 to 3 quarters, that's not really that long. So I thought, well, that's a pretty good question. So her answer really focused on the labor market. The labor market has not adjusted, and used the words far too strong. So it would be a mistake to stop raising rates now. And then concluded with, this is where you have to think about continuous tightening, is the labor market. And I said that about a month ago, that really, we're done inflation watching. Now it's wage watching. That's where all the inflation is going to come from, is you have to watch the labor market. Structural shortage. There is a structural shortage. We're not seeing a recovery in supply. The 55 plus group, not just retirement. And by that it means that there is a natural rate of retirement that's going to happen because of the baby boom cohort. But that the amount of individuals leaving in the 55 plus group exceed what would be normal if it were just retirement. So it's not just retirement in the 55 plus group. And the new cohorts coming in are just working less, so that the participation rate among the new cohorts is lower than would be expected, and you have a faster exodus in the 55 plus group, and immigration has dropped and is not recovering. Well, you have very low population growth organically. You have immigration that's dropped and not recovering. You have the 55 plus that's exiting faster than retirement would say, and the new cohorts coming in are not coming in at the rate that they should. So that is what she sees as the big problem right here. So if we're talking about long and variable lags, variable she agrees with, but long, the 2 to 3 quarters, you got to change that for the fact that the labor market is just not adjusting. This was a really interesting question. And I had pointed this out before, that you had huge accommodation in monetary policy after the great financial crisis, and you had no inflation. It didn't do anything. And this was sort of the case that I was making, that this really is primarily supply driven, is because if anything was going to be inflationary, it was all of that, and it wasn't. So somebody said, is monetary policy less effective these days? Because pre-2020, you could not get the PCE up to target. And she had a graph that she had put on the screen showing the 2% and showing PCE was doing this pre-20, was if that's 2%, was sometimes as low as 0.8%, that the PCE they couldn't get it back up to target. And their exemplar was Japan, that they did not want to be another Japan, where you have to keep stimulating to try to get any kind of inflation at all. So they were extremely accommodative, and they couldn't get up to target. So the person asking the question points out, post 2020, maybe monetary policy just can't get it back down. And she does concede that there are fewer interest rate sensitive sectors in the economy, so that there might be something to that. Because it is a good point. You had all of this stimulus, all of this easy money for almost a decade, and you couldn't get PCE to your target. You shut down the economy, you disrupt supply chains, you get inflation. Maybe you're thinking that monetary policy can get it back down, but if it couldn't get it up, what makes you think it's going to get it down? I think that's a good question. Okay, here is Barkin's speech. It was on the website, on the Richmond Fed's website. I just cut and pasted it because I wanted to highlight certain things. We're going to read quite a bit of it because it is, when I read it, I thought, this is so good. And we'll just read the highlighted parts. The prints we see largely coming in with a month's delay and can be revised multiple times. And I've explained this last week when I said, when I drew that picture, I said, imagine a large ship going through a narrow channel and you can only steer it by looking backwards. And that's exactly what he's saying here. The prints we see largely coming in with a month's delay and can be revised multiple times. Let's start with demand. In January, real consumer spending saw the largest monthly increase since March 2021, up 1.1%. Real disposable income jumped 1.4% as January wage and Social Security increases came online. Real-time information from credit card companies confirms that consumers spent freely in January. So I see the jump as real, but doubt that it is as large as portrayed or is sustainable. The weather has been unseasonably warm, and that has likely goosed spending. Yes, he said goosed. This data is seasonally adjusted, and I do wonder whether the last two January's COVID-19 outbreaks didn't amplify the strength of this January. And this is an important, an interesting paragraph here. Seasonal adjustments also matter in the labor market. We saw a huge jobs number in January, more than 500,000 added. But to give you a sense of how these adjustments work, normally employment drops by about 2 million in January as holiday hiring is reversed. This year, employment dropped only 2.5 million. After adjustment, you see the 500,000 growth number. It is likely that in today's labor market, employers were more reluctant to shed workers than in previous years. I think so. So that you had some labor hoarding going on. But so the January report, we saw an increase of 517 million. He points out here is that employment should have dropped by 2.9 million. It only dropped by 2.5 million. Hence, there's the plus 517. Meanwhile, employment still dropped, right? Labor market is still quite tight. Employers tell me they aren't as desperate as they were a year ago, but it is still difficult to find workers. Nursing, construction, and mechanics, nursing being a big one. Finally, let's spend some time on inflation. After several months on a downward path, inflation accelerated in January in both month-over-month and year-over-year terms, and the encouraging fourth quarter inflation numbers were revised upward. And I had pointed that out as well. You might hang your hat on the transitory concept. Now he does, he puts out three different arguments here. You might do this, or you might think, and then he sums up in the end here. So these are not things that he's putting out there as this is what we think. He's sort of talking to the audience saying, some of you may see it this way, and some of you may see it that way. You might hang your hat on the transitory concept. Transitory has two different definitions: brief and not permanent. Inflation certainly hasn't been brief, but maybe getting to the other side just takes time. After all, supply chain issues are easing. Most people are back to work. Transportation costs have come down. Broad commodity price inflation has returned to pre-pandemic levels, and fiscal stimulus is waning. If inflation was largely physical or fiscal driven, then it could decline pretty quickly as we return to normal. Now, he's not saying that he believes that. He's saying you might think this. There's some of you that might think this, or you might think the Fed's rate hikes and balance sheet reductions thus far are sufficient, but will take effect with the usual delay. Our moves impact financial conditions fairly quickly, but take time to work their way through the real economy. If we've hiked enough, as we make our way through that lag, inflation could quickly fall. After all, liquidity is leaving the system, the housing boom has subsided, demand is likely normalizing, and wages are settling. Or you could believe this. You could believe the Fed is going to do more than we have signaled to date and is planning to clamp down in an even more aggressive manner, risking a deep recession to snap inflation down quickly. Volcker proved we have this power should we want to use it. To be clear, I have not seen anyone suggest inflation has yet become the problem Volcker faced in the early 1980s. By this point, you might have gathered I don't think normalization will be this easy. So I have this fear that the market is going to read this paragraph and go, okay, stop reading, we have enough. We return pretty quickly to normal. Oh, let's read the second paragraph. Well, he's saying it's going to return fairly quickly to normal. Okay, let's stop reading and move on. By this point, you might have gathered, I don't think normalization will be this easy. I wonder if the market read that far. Market seems so eager to hear one word, hear what it wants to hear, and then just stop at that point and move on. Returning prices to the stability of the last 30 years will likely take a lot more time and effort. I think my view is in step with the actions of the FOMC and with the most recent summary of economic projections that showed inflation not returning to 2% until 2025. Why do I see this fight lasting longer? Over $1 trillion in excess savings are still funding consumption, as are continuing fiscal outlays like the infrastructure bill. New auto inventories and houses for sale remain near historic lows, supporting prices in those sectors. Supply chain challenges remain, for example, in switchgears and cabinets. I don't know what a switchgear is. I should Google that. The labor market remains historically tight, as I said earlier, and China's reopening and events in Ukraine may well also pressure commodity prices. I hear from a number of sectors, like healthcare, utilities, and food, whose margins have compressed and who feel the need to restore them through further price increases. This is going back to the statement I made earlier about anti-disinflationary practices or inflationary desires. Workers whose real wages fell are pressing to catch up. I've heard many larger than normal increases in the end-of-year merit process. I'd also like to point to inflation expectations. This is interesting. There's been enough movement under the surface to warrant caution. The University of Michigan Survey of Consumers has seen the one-year median expected inflation rate fall from its pandemic high of 5.4% to 4.1% in the most recent reading. But this masks an increase in the range of responses. By one measure, that spread is at levels last seen in 1982. And research on the 70s found that an increase in the standard deviation of inflation expectations preceded high and unanchored inflation expectations. It's worth remembering that even with Volcker's aggressive approach, it took years to corral expectations back to a narrow range. Let's just take a moment here. What he's saying is, yeah, you see 5.4 fall to 4.1. But what you're not seeing is the standard deviation in the responses, and that standard deviation is at levels last seen in 1982. And research shows that when the standard deviation of inflation expectations increases, it preceded high and unanchored inflation expectation. Well, that's not information he's keeping to himself. That's information he's sharing inside the meeting. That we don't see. This is the first time I'm hearing of this. The first time I'm reading this, saying, "Oh, this is pretty important information. Maybe this should be released with the numbers." It's like when somebody says, "I'm a fund manager. Here's my last 5 years CAGR, 7.2%. Yeah, that's great, but what's your standard deviation, right? It's all because that's where the risk is in the dispersion of the results, not in what you got, but what's the dispersion of the results. Well, this is important. I would encourage you to read that paragraph again. Most fundamentally, 2 years of high inflation and ubiquitous conversation about inflation has surely had an impact on firm behavior. This gets really interesting. For a generation, business leaders have learned not to count on pricing to drive profits. Now pricing is back in play. Its impact is considerable. Successful increases flow straight to the bottom line. Let's go back to what I said about inflationary desires and anti-inflationary practices. Successful increases flow straight to the bottom line. Businesses have found inelasticity they hadn't had the courage to test for previously and are looking to find more. They have found inelasticity they hadn't had the courage to test for previously. Much like the employee who never had the guts to ask for a 15% wage, now has the expectation that they're going to get a 15% wage. Now not only has the guts, is going to walk in there and just say it as their opening thing. I need 10, 15%. Never said it before. Supply chain challenges have worn down purchasing departments. They now seem more willing to accept increases at a time when volatility has made supplier cost structures more opaque and availability more important. In most companies, there is a continual tug of war between a finance team that sees price as a path to profits and a sales team that fears loss of business and market share. Sales won for years, but finance is winning now and will continue to keep pressure on prices until customers and competitors reassert themselves. I got to go back to the inflation expectation and the volatility of inflation expectation, especially preceding high and unanchored inflation expectations, along with the change in behavior, that they are now becoming addicted to this drug. Read it again. Successful increases flow straight to the bottom line. Businesses have found inelasticity they hadn't had the courage to test for previously and are looking to find more. Wow. Inflation is likely past peak, but I think it will take time to return to target, and as a consequence, believe we still have work to do. We have forecasted additional rate increases, and the SEP has made clear that we don't anticipate rate cuts this year. The Fed is the organization charged with fighting inflation, and we have made our resolve clear. The experience of the 70s is compelling. If you back off on inflation too soon, it comes back stronger, requiring the Fed to do even more and with even more damage. I'd like to avoid that. But with real rates having risen dramatically in the last year and sitting at positive levels across the curve, it makes sense to move more deliberately than we did last year. And I think deliberately is the wrong word to use. I think he's meaning deliberately in the sense that we should move more thoughtfully is probably a better word. Whereas last year it was just throw everything we have at this. Let's get it done. 75, 75, 75. But real rates are high now, so let's deliberate on this a little bit. I think that's what he meant there, as opposed to, you can read that as more aggressively, more deliberately than we did. We would all like inflation to fall quickly back to target. I'm confident it will in time, but doubtful the process will be quick. The big stuff happens after what I think the market will pay attention to. Oh, he said it's going to decline pretty quickly. Oh, he says it's coming down fairly quickly and likely to normalize, and wages say, everything's good, let's stop reading. But here, the volatility in the inflation expectation and the observation of what it did in the past, and the observation here that companies are becoming addicted to this, that they actually would like this to continue. They want these price increases. It's not inflation expectation, it's inflationary desires at this point. Okay, looking at the one of Daly's comments about reshoring. Look what's going on with the Mexican peso here. This is a 5-year chart of the peso, 5-year high. look where it is here. You got to go back in. This is just barely touched that 5 years ago. We're sitting at a more than 5-year high on the Mexican peso. Tesla had announced its next factory. It was going to be in Monterrey in Mexico, $5 billion investment. And when you count all of the other suppliers that have to show up and invest, the total is $10 billion with the supplier investment that you have to put in place. BMW, GM, Ford, they have all previously announced that they're dedicating investment into Mexico as well. Look at that peso. I didn't think we'd see a 17 handle, but there you are, 17.95. When it was in the 20s, I thought we could print an 18. But I just didn't think we could make it all the way through the 18s into the 17s. So I would love nothing more than for there to be a little bit of trouble and it could retreat so I can really grab a nice big chunk of it back up around the 19 to 20 range. That's on my radar. I see the peso give me any weakness at all over a period of time. I will grab it for sure. Okay, lots of interesting stuff here this week. Let's look at our forward 4-quarter earnings, 219.13, and it has dropped 0.58 week over week. It was 219.71. Closing SPX was 40.45.32. Gives you an 18.46 times forward earnings multiple. June ES ended at 408.925. You can see the carry in here is down to about $44. My average price on this is $41.47. It is actually higher because I am making more on my tactical trading. It just gets to a point that why do I continue to add? I'm just going to count the other stuff as profit now. So it's 41.47 plus. You know, it can go up much past 41.47. I'd still, out of everything I've done, haven't lost anything yet, so I'm quite comfortable with that. This is interesting. Now, keep in mind this is earnings, right? What did we just saw a report from UBS that showed that the cash flows were some 15% less than earnings adjusted for depreciation and amortization. So let's look at our yields, our earnings yield. Our earnings yield is not our cash flow yield. Right? The cash flow, based on that report, cash flow would be some 15% lower. So we're looking at an earnings yield, which is measuring some rather poor quality or a quality that's not as good as we would like it to be. Earnings yield is 5.42. The cash flow yield would be lower than that on equity. Okay, so this is 5.42. Your 6-month T-bill is 5.18. 1 to 3 year investment grade is 5.64. Look at this. That is negative 22 basis points. It's not plus 10 basis points or 15 where I then say that's all you're getting. You're only picking up that many basis points to take on that risk. You're actually giving up basis points now to take on a wider range of outcomes. So if we look at 1 year IG and we just think about it in terms of the yield you'd get, the distribution around that yield is very, very tight. If we look at equities, and I'll draw this other line, our expected return is now lower, or the yield, I shouldn't say expected return, the yield is now lower, but you're taking on wider distribution. So in other words, you can get 5.64, or you can get a yield that's lower that has a wider range of outcomes, more uncertainty in the outcomes. So you can take on more risk for less return. That's what it's saying. And not only that, this is the earnings yield, which we've already seen has got the lowest quality of earnings since 1990. Negative 22 basis points. Something is absolutely mispriced here. Absolutely mispriced. My macro overlay, I'm short beta, long duration. I've added heavily to my negative beta. I shorted more June ES contracts, and I sold on June. I sold the 4,000 calls and the 4,100 calls. I'm more convinced. I'm not one of these people who think we're going to 2,000 or 2,500, but I'm more convinced that we simply can't stay at 18.46 times earnings when you have the 1 to 3 year IG paying 5.64. You have a 6 month at 5.18. and you're taking on an earnings yield of 5.42, knowing that the gap between earnings and cash flow is the widest since 1990. I can't put that puzzle together in my head right now. You've had earnings dropping this quarter. Every week we've looked at it, the earnings have come down. Every week we've looked at it, they've come down, and you have central banks that are still raising rates. That does not sound like the initial conditions of a new bull market to me. Not in the least. So I have no choice. I have no choice but to add to my negative beta position. I am now net, not just net, but a decent part net short beta at this point in time. Word of warning, I'm comfortable doing this. I am more than comfortable doing this. Okay? If you're not, don't do it. I'm more than comfortable. You must arrive at your own conviction for doing this. On top of everything else, look at the implied volatility here. 13-week is down to 15%, was 59% last week. The 26 weeks down to 7%, was 30%. You can see the huge drop off at the end of this screen here. Implied volatility last was 17.1. Last week was 19.8. Volatility has really come out of the S&P to the point that it just, you look at it, you say, I think the equity market is extremely, extremely confused right now. Either that or there is some structural issue in the market that is disallowing it from repricing it correctly. And there's been a lot of talk about 0-day to expiration options, and could it be something in there that because the volume of them is so high, and since it's 0 days to expiration, they tend to be very close to where the price happens to be, that so much of the volume from the dealers has to happen in and around that pricing that it's not allowing prices to either rise too much or fall too quickly. Maybe there's something there. But usually when the fundamentals show up, they trump everything else, and I guess we just have to wait. But the mispricing just doesn't seem to be doing anything. You have, think about that. Think about saying to somebody, listen, you're in a safe place right now. Why don't you pay me money to go to a risky place? Because that's really what this is. You're going to give up 22 basis points to go to a risky place. Oh, and that risky place is not going to be the true risk. The true risk is somewhat bigger. We're just sort of hiding it with this definition of earnings. By the way, the volatility, like the amount of fear that you should have, it should be really, really low at this point. I can't even begin to describe how wrong this all feels. 50-day moving average, 397.49, we're above that. Held the 200-day, 393.16. It came down to the 200-day, and a couple of times it tried to get past the 393 and just couldn't. Held that. And, well, for many market participants, especially the more high-frequency traders, if a market's not going down, it must be going up. Equilibrium level, take the long-term forward PE. So you have, you can look at your PE over time, and then if you find your long-term, actually it looks more like this, and you look at the long-term, 16.6. So if we take 16.6, if we have an expected return of 11%, take 1.8 off for the dividend, you have an equilibrium expected return. You can call it a CAPM return of 9.2%. So we can set a year-end target by taking where 16.6 times earnings are, 219.13, that would be 36.37, and increase it by 9.2% because we're looking for a price target, not a return target. We are getting the dividend, and when you get the dividend, the price drops. So the price target, 39.72. Again, that's an equilibrium price, 39.72. And if you're going to use cash flow on that instead, say, well, let's equalize cash flow and income, because in a perfect non-accrual world, that's what it would be. You got to go 15% lower than that, 600 points lower. Ouch. I get you down to 3,400. Friday's put call ratio 1.52. That is quite high. Open interest 2.05 versus 2 last week. For me, it just is quite clear. You have a Fed that is focused on core services ex housing, which is primarily driven by labor. You have almost every Fed official saying that the labor market is far too tight and they're watching that. You have a structural shortage in labor, which they're all quite aware of. And I don't see that fixing itself anytime soon. Add to that the lower quality of earnings, the high share of companies that are not profitable in the Russell 3000, and the elevated standard deviation in terms of inflation expectations. Along with some of that, the GM story about, not overproducing to create disinflation, and with companies being hooked on those price increases as a way to make their bottom line, I just can't see how rates are going to come down because inflation is simply going to melt away. And I believe the Fed. I believe that they're going to keep at it till the job is done. And this job is not going to be done until you significantly break that labor market, and that's only a recession. That's the only thing that can happen. No matter how I look at this, earnings have got to come down. They've got to come down. You can do accounting to make your numbers for a period of time, but at some point, you run out of accruals. At some point, it has to reverse. At some point, something has to happen. So to say that earnings have got some downside, I think is true. To suggest that the risks to the economy are skewed to the downside, I think is true. That inflation is probably skewed, the risks are skewed to the upside primarily from wages, I think is true. I cannot find a bullish case that I can sleep at night other than, okay, well, we might have some bullish sentiment for a week or two. Till another number comes out and who knows what that's going to be. Or you get a data point that comes in just lighter than expected and okay, well, there we go. There's your bullish sentiment until the next data point comes in, because everything seems to be taken just as the number that's given. Recall what I did last week with the inflation numbers, the revisions, and I showed you where all the plus signs were. That had those numbers came out then instead of the lower numbers, we wouldn't be here. We wouldn't be here at all. So that when we see a number now, it's the revision. Keep in mind there are revisions that come out over time, and the revisions, especially when it's come to inflation, have always tended to be upward revisions. So here we are. Let's have a look at our economic calendar next week, because it is a risky one. All right, let's look at our economic calendar. We'll look at Canada, US, and Japan. Japan really only has one thing. I think we can get that out of the way. If we scroll down to Thursday night, 10 o'clock, be aware you have a Bank of Japan interest rate decision if you have anything to do with the yen. Or if, some funny things happen on Thursday after 10 o'clock, you can at least know where to look. Well, there must have been something about the BOJ decision. They're not expected to change the interest rate. There is a growing consensus that they're going to have to abandon yield curve control. With inflation above 4.5%, the job is done. They can't keep the 10-year at 0.5 and continue to defend it. The longer they do, the more money leaves the country and looks for yield somewhere else. So the belief is they're going to have to abandon it. So that's why it's of interest right now, is because if they do, then it's a bunch of implications of, well, what does that mean for the carry trade? What does that mean for U.S. Treasuries? And the big question, the answer to that big question right now is I'm not really sure. But let's just see if there's any kind of hint that that's going to go on. Then we'll start to see the beginnings of what would happen. For the U.S., the big risk begins Tuesday, 10 o'clock, Fed Chair Powell testimony, and followed again Wednesday at 10 o'clock. So it's 2 days in a row. And we get consumer credit change later on Tuesday. Going into Wednesday, you get 8:15, the always wrong ADP report. Then you get balance of trade for both Canada and the US. 10 o'clock, you get the Bank of Canada interest rate decision, which coincides with day 2 of Chair Powell, which coincides with the JOLTS report, the job openings and quit rates. I don't expect that you're going to see job openings under 10 million or the quits rate under 4 million. I'm not sure there's going to be a lot of information in there that is not going to be overshadowed by what Powell said the day before and what he's expected to say this day. Keep it going here all the way into, there's the Japan interest rate decision. You get all the way into Friday. Canada has its jobs report at the same time that the US has its jobs report. There is your week. 2 days of Powell, one Bank of Canada decision, which is expected to be no change, one Bank of Japan decision, which is expected to be no change, and in doing no change, it'll probably change everything. And then, of course, you have Friday with the jobs report. Be safe out there.